Let's move on to our first management conversation on the show. Then Indian Railway Finance Corporation is in focus after it has returned to the external commercial borrowings market after 5 years. The PSU has raised about 300 million in yen from Sumitomo Mitsui. We have with us Mr. Manoj Kumar Dubey, CMD of IRFC, and we want to focus on three key points. One, of course, is the whole thought behind returning to the ECB market and what it really means for the cost of funds. And we want to understand what the asset diversification can spell for IRFC's margins, because they're looking at many more segments beyond just the railways when it comes to financing now. And finally, we'll get a check on the disbursement guidance for FY26 as well. Mr. Dubey, thank you so much for joining in. So let me take up the first point. You're going back to the ECB market and raising loans in yen. And so this is very interesting at a time when the general expectation is that interest rates in Japan will actually rise, or could actually rise, because of what's happening with inflation in that country. Just tell us how this makes sense for you. What will be the cost of servicing this debt? And what happens to the currency risk? Because, this borrowing is happening at a time when the rupee is, sliding to past 90.
So, morning, Surabhi. There are a few corrections in the beginning. One, that we are re-entering into ECB market only after 3 years, not after 5 years. And two, this loan is for $300 million worth of yen that we signed day before yesterday in Gift City. So, we have a very long relation with the Japanese banks for raising ECB loans. And yes, yen is a bit fluctuating currency. But, once the rates go high in that side, the hedging cost comes down. So we have our own experiences, and we feel that going forward with the kind of hedging cost optimization, we feel that this is a very, very good opportunity to put yen also in our mix of borrowings.
Okay, so now that you're back in the ECB market, what is the cost of this borrowing, the yen borrowing that you've done? How does it compare with your blended cost of borrowing?
Yeah, so I won't tell you the rates, but as we have come to know that in the year 2025, this is the best ever rate that we have got by anybody who has raised the yen in the market. So that is a reinforcement of the fact that our zero NPA status and the kind of the fact that we are lending to the government entities, not limiting to railways now, still commands a very good respect in the lending market. A. B, to share with you, we are also opening one more bid on 8th of December itself for 400 million worth of dollar yen. So we are a little bullish on this regards for the fact that our disbursement have started now, picking up the pace with more than 50,000 crores of assets already being signed. So we want that in a healthy manner, 25% to 30% of my borrowings would come from the ECB, and right now we are focusing mainly on yen as one of the foreign currencies.
Sir, but how does that make commercial sense for you? If you could help us understand, because interest rates here in India and the expectation is maybe we'll still get some kind of rate cut. So I'm just trying to understand how borrowing in yen makes commercial sense versus, say, rupee loans here or loans elsewhere.
The AAA bond market here or the bank rates that we are getting here, and of course taking into account for the fact that there may be a repo rate cut also again. For 5 to 10 years tenure, we feel that with the hedging cost, the lending will be around somewhere between 6% to 6.2% from the yen also. So that makes sense for us. We cannot put all eggs in one basket. So we feel that for the longer tenure, with all the things taking in together, this will be a very lucrative and attractive mix in the total basket that we are trying to create.
Oh, okay. So hedging costs and all other costs put together, the cost of borrowing in yen should be around 6.2.
So it should, yes.
Okay, and you said that you want to shift almost 20 to 25% of your borrowings to the yen over what period of time?
Not yen really. The kind of mix that we create in the total mix, nearly 50% kind of thing we go for domestic bond. Another 20% to 25% we look for lending from the banks. And the next 25% we always try to have the ECB kind of mix. And dollar is also one of the preferred currency. We'll have a look on that also. But right now we have done our own calculations, and we feel that to start the ECB market, yen is a better buy for us, having all our experience in the last decade or so. Number two, we also came out with zero coupon bonds successfully in the market. In fact, we mopped up around 3,000 crore. We are the first in this calendar year, which is ending now, to successfully have mopped zero discount bond, which came out at 6.8%, nearly 35 bips discount to the domestic bond rates. So we are on now on our targets of mopping up funds for disbursement, which is picking up for my company.
Speaking of disbursements, sir, let's talk about the business overall. If you could just tell us now, how strong is the second half looking? Where do you finally think you'll end in terms of the overall growth of the book, growth in disbursements? And what is the plan of growing the newer segments? And you want to get into so many segments, logistics, sports, renewables, so on and so forth. So just give us some perspective.
So as we discussed in the last two con calls, after con calls when we came to CNBC, so we are on the right track. So what we spoke about, we are walking our talk. So end of the Q2 or H1, we first had a very healthy order book with us. We sanctioned and signed agreement for more than 50,000 crore of worth assets, all in the government parlance, including CPSEs and state government entities who are doing very well. And now we are focusing in S2 more on disbursement, as we have given a guidance of 30,000 crore disbursement in this FY, which we are right on track. So, and for precisely for that only, we are raising funds from the market, domestic as well as the foreign markets. So I reiterate our guidance that we will be ending up more than 30,000 crore of disbursement this FY. And so far as our guidance for 60,000 crore of sanctioned assets, we are already near to finishing that in this month itself. So we believe that by Q3 we'll be overshooting the target that we gave ourselves for sanction of the estimates. There are a lot many things, as you rightly mentioned, is coming in terms of metro railway assets, port assets, multimodal transport assets, logistic assets. And we feel that with the kind of attractive rates that we are offering to the market in the government sector parlance, we stand to gain a lot of business coming ahead, maybe in Q4 as well as in the next 2-3 years. There is a very clear-cut visibility of the businesses lying on the plateau.
And with this diversification, if you could just tell us, say end of, now this year is almost going to get over, but say end of FY27, what will your asset book look like? What will be the mix? And as you keep diversifying, what should we expect on margins? How will the margins improve from the current levels?
So that is the most important and sweet spot that this company, as you rightly mentioned. All last 40 years we were doing business with Indian Railways on cost plus model where my margins was only 40 bips. Now the business that we are doing in diversified mode in the government ecosystem itself, my margins are more than 100 to 150 bips. So NIM is going to show continuous improvement every quarter, as I've been telling in all my con calls. We are already crossing 2% of NIM compared to 1.4 for the old assets. And we believe that with the margins that we are getting, despite being very competitive and bidding the bids where almost everybody, right from the banks to NBFCs are participating, because we historically had 40 bips margin business, 120, 150 bips margin is very good, and my NIM will be showing continuous improvement for 20-25 quarters, I can say.
So for your new assets, your NIM is already, you're saying, touching 2%. At a consolidated level, your NIM is about 1.5%. Where will the net interest margin be by the end of this year, sir?
So, 90% plus of the assets are having a NIM of 1.3 to 1.4. So, on overall basis, my NIM will be growing in this line only from 1.4. We have come to 1.5. Maybe we end up at 1.6 or 6.5, 1.65 overall. But we have two segments now. One is the railways, where the NIM used to be 1.4, 1.3 to 1.4. Two, the new assets that we are adding, they will be having a NIM of more than 2%. So, taking two together, slowly, when the diversified assets will be having more of the percentage, overall NIM will be showing a very steep increase going forward. And that is why I mentioned that for many quarters going ahead, my NIM will be showing a steep rise every quarter.
Okay. All right, we'll leave it there, sir. Thank you very much, and good luck on those borrowing plans and how the mix changes. We'll keep in touch. Appreciate it very much here on CNBC TV 18.